Morning, everyone. Thank you very much for joining us today. As Greg said, I'm going to talk a little bit about where we're finding opportunities within the equity markets. And I'm going to kick off with a slide that I've probably shown to a few of you before, and it's the PE ratio of the local industrial index. And we're going back in excess of 50 years here, and it's only been this high 2 times. So what does it tell you? It tells you that there are very high expectations baked into a number of large stocks on the JSE. We're in tough economic times, and the ability of most of these large cap industrial companies to meet those expectations is probably unlikely. Those of you that know PSG Asset Management would know that we prefer to go where expectations are a bit lower. We're looking for high quality companies, but companies that are cheap, and cheap for a reason that we think is temporary, some kind of fear or uncertainty, as Greg alluded to. In these tough times, we think probably the most important characteristic of a business to get you through and generate long-term returns for you is going to be to have a strong management team. And we think of the management teams that we invest in as custodians of our clients' capital. We like to think that we're investing in businesses and not shares. And as I'm going to show you now, the way that management teams allocate capital over long periods of time is probably the fundamental driver for long-term shareholder returns. If any of you are long-term investors like we are, I sincerely recommend you read a book called The Outsiders. What this book is about is it chronicles 8 highly successful but unconventional CEOs in America, the likes of a Buffett, a Malone, a Singleton. And what these CEOs have managed to do is outperform the average CEO on the US stock market over very long periods of time and by a significant margin, something like 6 times. I don't have time today to go into all of the characteristics of what makes a great CEO and how they generate these long-term returns, but I'm going to dwell on the one fundamental aspect, and that is that these CEOs have thought and acted like owners. And what that means in practice is they've made decisions in terms of how they run the company and decisions as far as capital allocation is concerned that is going to generate long-term returns for shareholders. So how do owners think, and what's different about thinking like an owner? If you're thinking like an owner, you're making decisions today that you'll derive benefit 5, 10, 15, 20 years down the line. You're not worried about what Wall Street or the analysts think of your earnings you're going to get 6 months down, your next earnings per share number 6 months down the line. You're going to invest when times are tough. You're going to invest in areas where people don't want to be investing. And most importantly, you're going to be looking after the capital in your business as if it's your own. Two very different ways of thinking about allocating capital, and each one of these CEOs has demonstrated tremendous success in this regard. The first is to make large acquisitions when the opportunity arises. So when a company that you understand is priced well and 1 + 1 can equal 3, to either borrow money or issue shares is a good idea. The most successful CEOs in this case were prepared to sit for long periods of time, sit on their hands, sit with cash on their balance sheet, and most importantly at times were prepared to use that cash to buy back their own shares. And if you're prepared to buy back your own shares, it implies you're not wanting to build an empire. It implies you're thinking on a per share basis and not at a total basis. and are thinking as an owner. What I'm going to do now is go into two specific case studies that I think will illustrate this a bit better. And the first is one of these quality anomalies that we refer to. And just as I was talking about Microsoft 2 years ago, we'd be talking a very similar message as far as IBM is concerned today. IBM, the US technology company, has compounded its dividends by 19% over the last 10 years. But today it trades at less than 10 times next year's earnings. Why would this be? The bear case as far as IBM is concerned is pretty well known. IBM has not grown its revenues over the last decade. And over the last 2 years, revenues or sales have actually gone backwards. But what we do know about IBM is that this is a technology company that has got more than 100 years track record of providing technology to its customers to allow them to operate more efficiently. And if you're providing technology, the one thing about technology is it never stands still. So IBM was the leader in tabulators at some stage. It was the leader in mainframes. It was the leader in PCs. It is fast becoming the leader in cloud for enterprises. And what they have to do is, as the technologies that they are invested in become more commoditized and attract more competition, IBM has a track record of more than 100 years of exiting those more commoditized businesses and investing heavily in new technologies so that they can allow their clients to operate more efficiently. So, as I said, revenues have gone nowhere for 10 years as far as IBM is concerned, but earnings per share have compounded at 13% per annum. And they've explicitly targeted $20 in 2015, which is 15% growth from 2013 levels, 15% in 2014 and 15% again in 2015. How can a company that's not growing revenues grow its earnings per share well into double digits, which is faster than the market? Two key areas. The first is, as the gold line shows, IBM has got a management team that's got a track record of growing its margins, of expanding its margins. And that methodology of exiting those more commoditized businesses in favor for higher value add, higher barrier to entry, less commoditized businesses has increased margins, which has obviously supported earnings per share growth. But equally importantly, IBM has thought like owners. And a business that generates significant amounts of cash, 85% of that cash has gone back to shareholders in the form of dividends or share buybacks. And if we were to look at IBM today, the running yield as a shareholder in IBM is close to 12%. So what do I mean by a running yield? I'm taking the dividend that's going to shareholders, and I'm adding to that the current level of share buybacks. And IBM is currently buying back in excess of 9% of its shares per year. Why is it doing that? Because it thinks its share is very cheap, so it's accelerated the program, and because they're thinking like owners. They don't mind shrinking the size of the company. They're not out there to build an empire. They're out there to generate the best long-term returns for shareholders. So as we like to put it, on a close to 12% yield, we feel we can own what we think is a high-quality business, and we think we're being paid to wait. And the reason that I think the market is being too bearish about the long-term growth prospects for IBM is that IBM has got a century-long track record of being at the forefront of investing in technology. We think IBM will grow its revenues in the future. We think we're going through one of those temporary stages when they're reinvesting for future growth. They invest more than $6 billion a year in research and development. That's in excess of 70 billion rand. They're also by far the largest lodger of patents in the US every year, a position they've held for 21 consecutive years. For us, this does not look like a company that's not going to grow into the future. I think this slide is very pertinent today, and what it does is it compares IBM to one of the darlings of the JSE, and that's SAB Miller. Now, I hope we're all aware that SAB Miller has been much in the news in the last couple of days. It was up 10% yesterday, and is considering that it's 10% of the JSE and we own none, we felt the pain. But what I want to show you here is the complete difference in thinking about capital allocation. So I'm showing you two companies that have similar track records as far as growth is concerned, and they're both global leaders, they've both got great management teams, they're both very strong in the markets in which they operate, and we're talking historic, double-digit type growth rates. IBM, incidentally, is slightly better as far as dividends are concerned, but it was off a lower base. The expected growth rates over the next 2 years, and I've just used analysts' expectations, are roughly similar, again, around the 10% level. But one trades at, after yesterday's move, more than 23 times, and one trades at around 12, or if we look forward at less than 10 times next year's earnings. So we're looking at 19 times next year's earnings or 10 times next year's earnings. What's the key difference here? And for me, the key difference is in capital allocation. The IBM management team is looking at a unique opportunity to accelerate a buyback of their own stock. SAB Miller, if we're talking that Foster's transaction it was 3 or 4 years ago into a structurally declining beer market, or if we're looking at Anheuser-Busch InBev trying to buy them, in the absence of growth, they're out buying each other and looking to take costs out of the system. And how are they doing that? They're going out there acquiring expensive assets. So for us, if we're looking at a company where there's very little growth priced in and we think those expectations are way too low, we think the odds are a lot more in our favor if we buy a high-quality company that's cheap, rather than a very expensive company on the basis of 10 years down the line, potentially costs could be taken out of the system that could justify 23 times earnings. The other sector I'm going to spend a bit of time on today, also in the context of capital allocation, is the mining sector. And the mining sector, if you want to choose one sector that's been the poster child for pathetic capital allocation over the last decade, we're talking the mining stocks. And I'll start with a little look at the CRB index over the last decade or so. In fact, last 20 years. We all know about the China-led big run-up into 2008. We know about the collapse in the global financial crisis. But what I'm going to talk about is why have commodity prices been declining since 2011? In a time where the world has actually been growing, albeit slowly, the world has been growing. As we know, growth rates in China have been declining, and I think that explains part of that decline in commodity prices. But I think there's a bigger, more fundamental explanation, and that has to do with how mining bosses have been allocating capital. And this chart, it shows you the capital expenditure by the big 5 mining companies, Glencore, Vale, BHP, Rio Tinto, and Anglo, since 2001. And what you will notice is that the ramp up in capital expenditure, in other words, the building of mines, accelerated through to 2011, 2012, and was at very high levels in 2013. And this explains why commodity prices have been weak. The supply just kept coming on. The CapEx budgets had been married to a super cycle view as far as commodities were concerned. And as Ivan Glazenberg, the CEO of Glencore, puts it, the miners just wanted to keep on building. There's a saying that if you give a miner a shovel, he's going to dig a hole. And I think that's been the case as far as the mining companies are concerned. One of the consequences of this almost reckless capital allocation has been massive impairments of asset values. Each one of those 5 companies has impaired roughly more than 10% of their market capitalization between the period 2008 and 2013. Cumulatively, those impairments, those write-downs, are about R1 trillion. So I think if we're talking capital allocation, it's been poor. But, and this is an important but, we're starting to see some good indications that some discipline is coming in as far as capital allocation is concerned. I think that makes sense because of those 5, only one company still has the same CEO as 4 years ago, and that's Glencore, Mr. Glazenberg. And Glencore is a company I'm going to talk a little bit now, talk about now in the context of capital allocation. And we're not looking at Glencore on the basis that we think it's been guilt-free as far as making errors, on allocating capital, but it has been better than the others. And there's one key reason that we stand in front of you today with confidence that they will be much better than the other mining companies in the future, and that's because management and staff own 37% of the company. There's evidence that they think like owners, but there's also very strong alignment to shareholders. And one bit of evidence in terms of why we think Glencore is and will continue to allocate capital better than the other mining companies. And remember, I'm not pretending that the other mining companies aren't improving. I think they all are. Is that if you look at where CapEx is going over the next 3 years, 4 of the big 5 are plowing their cash into iron ore. They're all building iron ore mines. The supply side, as far as iron ore concerned, in 2014 is going to be 17% higher than it was in 2013. The world is just about to be awash with iron ore. It's a market that looks like it's going to have some significant challenges. So we would take comfort, more comfort from a management team that is allocating capital better. We take comfort from the fact that we think they will think like owners, that they should be aligned with shareholders. As far as Glencore is concerned, we think it's an attractive commodity portfolio. There's no iron ore. It's well positioned on the cost curve, and they're in the right commodities for the moment. We think the valuation is good. We think Glencore trades at roughly 10 times normalized earnings, and those normalized earnings factor in a fairly conservative recovery in margins, but no increase in commodity prices. We think we get an increase in commodity prices for free as far as Glencore is concerned. Glencore has one of the world's largest commodity marketing businesses within it, which is unique. That gives them tremendous insights into what's going on in commodity markets. It's a high barrier to entry business and capital light, which is a very attractive business as far as we're concerned. And I think probably most importantly, if you look out over the next 5 to 10 years, the free cash flows that we expect from Glencore, even in a relatively tough commodity market, are going to be very strong. And we take tremendous confidence from the fact that management are likely to employ that cash that comes out of the business in a shareholder-friendly way. So this is a commodity company, a miner, that we will be much more comfortable with partnering with over the next 5 to 10 years. As promised, a quick snapshot on our top holdings in the PSG Equity Fund. I guess your first observation is that you'll see that we don't feel compelled to own something just because it's large in the benchmark or large in our competitors' funds. We think we can find better opportunities than Naspers, SAB Miller, etc. And these are some of those opportunities. Many of them come from outside of the top 40. Glencore, even though it's an 850 billion rand company, it's not in the index. It's only been recently introduced to the South African stock market. And other companies like Capitec and AdCorp would come from outside the top 40. Both of those classic examples of companies where we think there's tremendous fear operating in industries where we think they have significant barriers to entry, strong management teams, and a great long-term runway for growth, which we can invest in at very attractive prices. We continue to find significant opportunities to exploit the quality anomaly offshore. I've spoken about IBM. In the top 10 of the PSG Equity Fund, we also have Markel, JP Morgan, and Capital One. As Greg said, despite our focus in trying to buy above average quality companies, the PE ratio of the PSG Equity Fund is significantly lower than the market. That gives us a lot of comfort about future returns. With that, I'm going to end. I thank you for your time, and I'll hand over to Ian, and Ian will talk you through where we see the risks and the opportunities in the world of fixed income and credit. Thank you.